Climate risk and ESG are no longer new concept for us. We are already seeing the effects of global warming, and everyone agrees that we need to behave. But the real question is, what can we actually do, and where should we begin? I don't have all the answers, however. A few years ago, I worked on developing insurance products that support the transition to a low-carbon economy, and that experience gave me some perspective on the role insurance can play. Today, I want to share those insights and explore what kinds of products and business models we, as rate-making and pricing actuaries, can develop in this transition. Insurance companies are risk managers and financial catalysts, helping business navigate transition risks while channeling capital towards sustainable technologies and investment. At the same time, insurance inherently carries a social and public mission, serving as a safety net for society. This dual role allows insurers to both mitigate the risk of failing the low carbon transition and create meaningful social value. In this talk, I will explain the role of insurers in this transition and how actuaries can make a meaningful contribution. Climate risks are usually divided into physical risk and transition risks. Physical risks are linked to the direct impact of global warming, such as extreme weather events, floods, wildfires, or rising sea levels. These risks cause property damage, disruption of operations, and declining asset values. Transition risk, on the other hand, arise from the transition to a low carbon economy. New policies such as carbon taxes, emissions trading schemes, and stricter environmental regulations may significantly increase operational costs. Existing high carbon infrastructure or fossil fuel assets risk becoming stranded assets, meaning they lose value or become useless. Companies may face financial problems if they invest too quickly in the new low carbon technologies. The value of fossil fuel companies' stocks and bonds can also fall as investors prefer green industries. Financial institutions do not produce physical products, so their direct contribution to environmental goal is limited. Instead, they play a key role in guiding customers to better manage climate risk and promoting sustainable practices. Banks sell green bonds and give lower interest rates to low carbon industries. Insurance companies limit or stop covering coal-related projects and give discounts for eco-friendly initiatives. Beyond this, insurers are also developing new insurance products designed to directly support the low-carbon transition. In the individual insurance sector, products that encourage carbon reduction are mainly seen in auto insurance. However, insurance for individuals is not enough for decarbonization. The key transition risks are deeply linked to corporate technology, policies, and financial structures. This is why commercial insurance plays a key role in supporting corporate decarbonization efforts. These are examples of insurance products for corporate decarbonization. Technology transition performance insurance covers technical risk of shifting to renewable energy or low carbon technologies such as performance failures of solar, wind, or energy storage projects. It is similar to performance guarantee or industrial or risk coverage, but can also include KPI-based insurance for carbon reduction targets. These commercial products enhance project stability for both lenders and investors, making low carbon projects more financially viable and attractive. The role of insurance companies becomes clear here. They cover transition risk to support corporate decarbonization while also transferring these risks to capital markets through insurance-linked securities similar to green bonds sold by banks. This helps attract more investors to support green projects. Insurance is more than risk transfer. It is a public good and a social safety net with the responsibility to drive sustainable progress. Decarbonization is not just a corporate challenge, but a collective task for our society. And insurers must behave as enablers of this change. Rate-making and pricing actuaries play a crucial role in emerging markets like this. We must actively support underwriters to identify new coverage needs, developing pricing models, and design risk mitigation strategies if we don't have any historical data. In addition to reinsurance, we can use ILS to share risk with the capital markets and support long-term goals. Ultimately, actuaries help insurance manages these transition risk in a sustainable way and enable society to move towards a stable, low-carbon futures.